Now we will talk about the transfer pricing for internal sales. That is, when the company dispatches the good or transfers the good from one division of the company to another division. Any division which is independent profit center has the option to sell it to outside units or to an inside customer or within the division. That is called the transfer. The price at which the goods are sold or transferred to the divisions within the company is called the transfer price. Now, how do you come up with the transfer price? One option is negotiated transfer price, second is cost-based, and third is market-based transfer price. Conceptually speaking, a negotiated transfer price is best, but there are practical limitations for using other two methods. Now, as far as the negotiated transfer price is concerned, in that case, there are two divisions. For example, let's take sole division and boot divisions. They are both divisions of Alberta Company, which makes rubber soles and for work in hiking boots. Now, division managers for each division are compensated based upon the division profitability. And management now wants the sole division to provide at least some of the soles to the boot division. So currently the sole is selling externally to the outside parties, external sales only, but now the management wants them to provide something to the boot division as well. Currently, this is what happens. For the sole division, it sells the sole, it makes the sole and sell it to an outside unit for $18, and its variable cost per sole is $11, makes a contribution margin of $7. At the same time, if boot division is buying it and it is selling it for $90, say it buys the sole for $17 from the sole division, its own variable cost is $35, then your contribution margin is $38. So the total contribution margin for the company right now is $45, $7 from the sole and $38 from the boot division. Now the question is, what would be the fair transfer price if the sole division sold or 10,000 soles to the boot division? One of the most important things in determining the transfer price is whether they have the excess capacity or not. In this case, if the sole division does not have an excess capacity, then we have to take into account the contribution margin lost, or that is the opportunity cost lost. So the minimum transfer price that is acceptable to the sole division will be the variable cost of $11 plus the opportunity cost lost of $7 for not selling the sole to an outside unit. For the sole division, the minimum transfer price is going to be $18. Boot division currently pays only $17 to an outside supplier. So boot division manager will not want to pay more than $17. And the sole division does not want to sell for less than $18. So there will be a problem in making any deal in this case. If the sole division has excess capacity, so it can produce 80,000 soles but can only sell 70,000 soles, then it has an excess capacity of 10,000 soles available. The contribution margin of $7 is not lost, so the minimum acceptable price in this case is $11 because there is no contribution margin loss, there is no opportunity cost loss. So $11 plus zero opportunity cost gives you the minimum transfer price of $11. In this case, a negotiation can take place because the minimum price for sole division is 11, maximum price at which the boot division is willing to buy is $17, or minimum acceptable to sole is maximum acceptable to boot is 17. So basically between 11 and 17 there would be some price at which both of them can agree upon. So as far as the negotiated transfer price is concerned, the transfer price is established between minimum that would be paid by the selling division and the maximum by the purchasing division. It is often not used because of lack of trust between the two divisions. Now take an example for the transfer pricing. There is a clock division for control and central cooperation, and it sells them to customers for $10 per unit, whereas the variable cost is $4 and $2.50 is the fixed cost. Now management would like the clock division to transfer 8,000 of these clocks to another division within the company at a price of $5. The clock division could avoid 50 cents per clock of the variable packaging cost, so that brings the variable cost to $3.50. So in this case, the transfer price, minimum transfer price is $3.50 because the variable cost is $3.50, and if the division has the excess capacity, then there is no opportunity cost lost. However, if the division is working at full capacity, in that case, the contribution margin loss is 10 minus 4, which is $6. So the opportunity cost loss is $6, and the variable cost is $3.50. And in that case, minimum transfer price would be $9.50. Now we'll talk about the transfer prices based upon cost. Now it can maybe based upon just the variable cost or variable cost plus fixed cost, and there might be some markup added by the selling division. So we'll talk about how to compute it. Let's take the Alberta company again. It requires the division to use a transfer price based upon the variable cost of the sole, and it has no excess capacity. What happens to the contribution margin for the two divisions? Selling price is $11 for the sole division, as that is the variable cost. There is no profit margin being added. Contribution margin is 0 because there is no difference between the selling price and the variable cost. This $11 at which the sole division sells the variable cost becomes the cost for the boot division. And the total cost for boot division is now $35 of its own variable cost plus $11 from the sole division. The total contribution margin for the company now is 44 because 90 minus 35 minus 11 gives you 44. And the total contribution margin per unit for the company goes down to 44 from originally which was $45 under earlier example. So in this case, the cost-based pricing is a bad deal for the sole division. Why? Because there is no profit on transfer of 10,000 soles, and it loses profit of 70,000 on external sales. So the sole division manager will not be happy. Boot division manager is happy because they were buying the sole for $17 from an outside supplier. Now they can buy it for $11 due to the internal transfer. So the boot division manager is happy. His compensation, if based upon the division performance, will go up. And if the sole division has excess capacity, the division will report a 0 profit on these 10,000 units, and the boot division gains $6 per unit. However, from the company's perspective, the company is worse off by $60,000. Why? Because sole division lost $7 in contribution margin, whereas the gain by boot division was only $6. So instead of $45 of contribution margin earlier, now the company is making only $44. So overall, the company basically loses $60,000. So in this case, this may not be a good deal for the company as a whole or for the sole division. Another way the transfer prices can be based upon is market. Based upon the market price, it can lead to bad decisions if you have excess capacity because the fixed cost will still be there, and it was the market price. The advantage is that it is indifferent between selling internally and externally, and it is a arm's length transaction. Now, here is another example. Suppose the plastic division of Western Company manufactures plastic molds and then sells them for $70 per unit. Its variable cost is 30 and fixed cost is 10. Management would like the plastic division to transfer 10,000 units at a price of $40. The plastic division is operating at full capacity. What is the minimum transfer price that will be charged? In this case, again, the minimum transfer price is $70 because you've got the loss contribution margin of 70 minus 30, which is 40, plus your variable cost of $30. So in this case, again, variable cost 30 plus lost opportunity or loss contribution margin of $40, get it to the $70 as the total price. When the companies globalize, then there are transfer between the divisions across the countries. So a division of Toyota Japan might transfer engines to Toyota USA and at a certain price. And whatever is the selling price for the Toyota Japan becomes the cost price for Toyota USA. This creates some issues with the taxation because of the different tax rates which are applicable in different countries. It becomes very difficult to determine the appropriate transfer price. Also, it is estimated that the IRS loses about $25 billion a year because of the missed or misappropriated transfer pricing by the Fortune 500 companies or the companies which have gone global. Let's take an example. Alberta's boot division is located in a company with corporate tax rate of 10%, and the sole division is located in a country with a tax rate of 30%. Let's look at the after-tax contribution margin per unit and under for the transfer prices of $18 first, and then we will look at the example with the transfer price of $11. So for example, for the sole division, you got the selling price of $18, variable cost is $11, before tax contribution margin is $7, and if you take out the tax at 30%, the after-tax contribution margin for the sole division is $4.90. This $18 at which is the selling price becomes the cost for the boot division, and the before tax contribution margin for the boot division is 37. Tax at 10% in that particular company gives you a tax of $3.70 for an after-tax contribution margin of $33 odd. The total contribution margin after tax for the company is $38.20. Now, instead of transferring it at $11, suppose the transfer price is instead of $18, suppose the transfer price is $11. In that case, the sole division contribution margin is 0, and the taxes obviously is 0. This becomes the cost for the boot divisions, which now has a before tax contribution margin of $44, but it pays tax only at the rate of 10%, so it pays $4.40, and the after-tax contribution is $39.60. So in this case, the contribution margin has increased when compared to the previous situation where the transfer price was $18, and the increase in the contribution margin per unit for the company is solely due to the differences in the tax rates between the two countries and the price at which it was transferred. So again, this is a very big problem for the Internal Revenue Services, and similarly for countries with higher tax regime in various other countries. So today we covered the pricing, both from the purposes of selling to external parties as well as internal parties. We went over the target selling price, and cost plus pricing. And then we did the then we used the time and material pricing to determine the cost of services provided. Then we talked about the transfer pricing using the different methods of negotiated prices, cost-based prices, and the market-based approach. Thank you very much. Have a nice day.